Today we look at the question of the red line, okay? Not a military red line, not the kind politicians draw in press conferences and then quietly erase when the cost of enforcement becomes inconvenient. A mathematical red line, a threshold in the architecture of global finance that, once crossed, cannot be uncrossed. And I need to tell you, it has already been crossed. Not publicly, not with a declaration or a treaty signing or a breaking news banner. It was crossed in quiet rooms, in bilateral trade agreements, reported on page 14 of the financial press, in central bank reserve allocation reports that nobody outside of institutional finance ever reads, okay? An empire does not end with an explosion. That is the Hollywood version. The real version is quieter. An empire ends with a signature on a new contract, a signature that redirects the flow of capital from one system to another. And the Gulf states, the very nations whose cooperation has sustained American financial dominance for half a century, are currently signing those contracts with Beijing, with Moscow, with the institutional architecture of the East. And by the time this process becomes front-page news, it will be far too late for the average citizen to do anything about it. Does that make sense? Now, the media, when it covers the U.S.-Gulf relationship at all, focuses on arms deals, human rights concerns, diplomatic rhetoric, the occasional royal visit. And that coverage is a deliberate distraction from the only variable that actually matters. Not the political relationship, the currency relationship. The question of what denomination the Gulf states use to sell their oil. Because that single variable, that one line item in a trade contract, is the load-bearing wall of the American financial system. And it is cracking, not metaphorically, mathematically, right? 3 phases. Let me walk you through the sequence. Phase 1, the Petrodollar Life Support. I have covered elements of this architecture in previous lectures, but let me state it with full precision because this is the foundation upon which everything else rests. In 1974, following the oil crisis and the Nixon administration's severance of the dollar's link to gold, the United States and Saudi Arabia formalized an arrangement that would quietly become the most consequential economic agreement of the 20th century. The terms were elegant. Saudi Arabia, and by extension, the broader Gulf Cooperation Council, would price and sell its oil exclusively in US dollars. In return, the United States would provide military protection and diplomatic support, okay? The immediate effect was structural. Every nation on Earth that needed to purchase oil, which is every nation on Earth, was now required to first acquire US dollars. This created a permanent, non-negotiable, global demand floor for the American currency. Not because the dollar was backed by gold, not because the American economy was uniquely productive, but because the energy that powered every economy on the planet was denominated in dollars. The currency was backed not by a metal, but by a molecule. And that molecule was controlled by American allies, right? But the pricing was only half the mechanism. The second half, the half that most people never learn about, was the recycling. Those petrodollars earned by the Gulf states did not remain in the Gulf. They flowed back into the American financial system. Treasury bonds, US equities, American real estate, defense contracts. The dollars left America to purchase oil and return to America as investment capital, a closed loop. A perpetual motion machine of liquidity that allowed the United States to run extraordinary trade deficits, maintain historically low interest rates, and finance the largest military apparatus in human history, all without triggering the inflationary consequences that would normally accompany such behavior. Does that make sense? This is the Petrodollar Life Support system. And the word life support is precise, not dramatic. Without this recycling loop, the United States cannot sustain its current debt structure. The federal debt has surpassed levels that are, by any conventional measure, unserviceable through growth alone. The only reason this debt has not triggered a sovereign crisis is that the world's demand for dollars, driven primarily by oil denomination, keeps the currency artificially strong and keeps borrowing costs artificially low. Remove the demand and the debt becomes visible, not theoretically visible, viscerally, catastrophically visible, okay? Phase 2, the silent decoupling. And now the phase that is already underway. The phase that the media is not covering with the urgency it deserves because covering it would trigger the very panic that the system requires be delayed. The Gulf states are not stupid. I want to be very clear about that. The sovereign wealth funds of Saudi Arabia, the UAE, Qatar, Kuwait, these are among the most sophisticated financial institutions on the planet. They employ the best analysts. They run the most advanced models. And those models are telling them exactly what the publicly available data tells anyone willing to look. The American debt trajectory is unsustainable. The fiscal math does not work. The United States is servicing its debt by issuing more debt, which is the textbook definition of a system approaching terminal velocity, right? And the Gulf states are executing the rational game theory response. They are diversifying quietly, methodically, without announcing it in a way that would trigger the crisis prematurely, because a premature dollar collapse would devastate their own existing dollar-denominated holdings. So the decoupling is managed, gradual, strategic, but it is unmistakable if you read the signals. Saudi Arabia has deepened its economic relationship with China across multiple dimensions. Energy agreements denominated in yuan have been discussed at the highest levels and, according to multiple reports, partially executed. The kingdom's sovereign wealth fund has dramatically increased its exposure to non-dollar assets and direct investments in Asian markets. The UAE has entered into currency swap agreements that bypass the dollar entirely for bilateral trade. Multiple GCC states have expressed interest in or moved toward BRICS Association, a bloc that explicitly advocates for de-dollarized trade. Central bank gold purchases by Gulf-adjacent and BRICS-aligned nations have reached levels not seen in decades. Gold, which is the historical exit from fiat dependency, the signal is not subtle, okay? And here is the game theory that governs the transition. No single Gulf state wants to be the first to publicly abandon the dollar. The first mover bears the maximum retaliation risk, diplomatic, economic, potentially military. But no Gulf state wants to be the last one holding dollar reserves when the system reprices. The last mover bears the maximum financial loss. So the optimal strategy is coordinated, simultaneous, gradual departure. Move together, move slowly. Maintain diplomatic cover, diversify reserves. Build bilateral trade channels that do not depend on dollar clearing. And by the time the transition is publicly acknowledged, the exposure has already been reduced to manageable levels. Does that make sense? This is what is happening. The alliance between Washington and the Gulf is not collapsing in a dramatic rupture. It is being carefully, rationally, mathematically unwound by sovereign actors who have concluded that the long-term risk of dollar dependency exceeds the short-term risk of diversification. The alliance is already dead in structural terms. The media simply has not informed the public because informing the public would accelerate the very dynamics the system needs to delay, right? Phase 3. The elite exit strategy. Now, if the Gulf states are quietly repositioning, the question becomes who else knows? And the answer is obvious. The institutional financial elite, the sovereign wealth managers, the central bankers, the billionaire class with direct access to the same data, the same models, the same signals that the Gulf states are reading. They know, and they are executing their own exit strategy in parallel. Okay? Let me describe what this looks like in practice, because it is not hidden. It is simply not narrated, not explained, not connected to the broader petrodollar context by any mainstream outlet. Institutional purchases of physical gold have surged. Not gold ETFs, physical gold. Central banks globally have been accumulating gold reserves at a pace that represents a fundamental shift in reserve management philosophy. This is not speculative. This is reported data from the World Gold Council and the IMF. The direction is unambiguous. Institutions are converting dollar-denominated reserves into a commodity-backed store of value, right? Simultaneously, there's been a significant and accelerating institutional move into hard physical assets. Farmland, water rights, energy infrastructure, critical mineral deposits, logistics assets, ports, warehouses, shipping capacity. These are not financial instruments. They are physical resources that retain value regardless of which currency denominates global trade. When you see a billionaire buying hundreds of thousands of acres of agricultural land, you are not watching a hobby. You are watching a hedge against fiat depreciation executed by someone who has access to information about the timeline of that depreciation that you do not have. Okay? And here is where the broadcast game operates. While the institutional class is quietly repositioning into hard assets and commodity-backed instruments, the public-facing media narrative remains unchanged. The economy is resilient, the dollar is strong, inflation is being managed, consumer confidence is holding. This is the broadcast. It is designed to maintain public confidence in the dollar-denominated system for exactly as long as the institutional exit requires. The middle class must continue holding dollars in savings accounts, in pension funds, in money market instruments, because someone has to hold the depreciating currency while the smart money exits. Does that make sense? The term for this is commodity-backed arbitrage executed under informational asymmetry. The elite have information, not secret information, but structurally inaccessible information, data that is technically public but practically invisible to anyone without the analytical infrastructure to interpret it, that tells them the dollar's reserve status is in terminal decline. They are converting their exposure from fiat instruments to physical assets. And they are using the broadcast game, the media, the official economic indicators, the reassuring press conferences to ensure that the general population does not execute the same conversion until the institutional repositioning is complete, right? When the petrodollar system finally breaks, not if, when the consequences for the average dollar holder are catastrophic. Trillions of dollars currently held overseas as reserve currency are no longer needed. They flow back into the domestic American economy. But these dollars are not returning to purchase goods or invest in productive capacity. They are returning because they are being rejected, exchanged, dumped, repatriated by foreign holders who no longer need them for oil purchases. The effect is a massive, sudden increase in the domestic money supply without a corresponding increase in goods or services. The textbook consequence of this dynamic has a name. It has always had the same name: fiat hypervelocity, the acceleration of currency circulation as holders attempt to exchange depreciating money for anything tangible before the next wave of depreciation. Okay? And who is protected? Not the family with a savings account, not the retiree on a fixed pension, not the worker whose salary is denominated in the depreciating currency. They are maximally exposed. They hold the empty instrument. They are, in structural terms, the bag holders, the last participants in a system that the sophisticated players have already exited. The elite hold farmland. The elite hold gold. The elite hold energy assets and water rights and physical infrastructure that reprices upward as the currency reprices downward. The middle class holds a number in a bank account. And that number buys less every single day until the system finds its new equilibrium, an equilibrium in which the average citizen's accumulated wealth has been transferred through the mechanism of fiat depreciation to the holders of hard assets. Does that make sense? So, the summary? Phase 1. The Petrodollar Life Support. The US dollar's global reserve status is sustained not by economic fundamentals, but by the Gulf states' agreement to price oil in dollars and recycle the proceeds into American financial instruments. This arrangement is the only mechanism preventing the US debt structure from triggering a sovereign crisis. Phase 2. The silent decoupling. The Gulf states, reading the same debt math available to any analyst, are rationally diversifying away from dollar dependency through bilateral trade agreements, currency swaps, BRICS alignment, and gold accumulation. The process is gradual, coordinated, and structurally irreversible. The alliance is functionally dead. The announcement has simply been delayed. Phase 3. The elite exit strategy. Institutional and ultra-high net worth actors are converting dollar-denominated wealth into physical commodities, hard assets, and commodity-backed instruments. The broadcast game, the media narrative of economic stability, maintains public confidence in the dollar for exactly as long as the institutional exit requires. When the petrodollar breaks, the resulting fiat hypervelocity destroys middle-class purchasing power, while inflating the hard assets the elite have already acquired. The red line is not approaching. The red line has been crossed. It was crossed in trade agreements you were not told about, in reserve allocation shifts you were not shown, in hard asset acquisitions that were reported individually but never connected into the pattern they obviously form. The multipolar reset is not a theory. It is a transition. And the question is not whether it will happen. The question is whether you will understand it before or after your purchasing power has been transferred to someone who understood it first. The middle class will hold the empty bag. That is not a prediction, that is the math. That is the lecture. If you found it useful, subscribe.